is it better to have this account or this account? If you're 70, you have this account, you don't own all of it, you have to pay tax, and you have to start taking out distributions. You have this, you don't have to pay tax and you don't have to do anything. You can let it grow tax-free. So there's a little bit more to it than these numbers, but required minimum distributions can certainly play into your decision.
In this example, you can pay that tax over 2 years based on today's.
Based on today's
So we pay
2010.
$56,000 this year and $56,000 next year.
Yes,
Okay.
yes.
We could have done it right along if we didn't earn over 100,000.
Yes. Determine how much to convert. You do not have to convert a full IRA. You can convert a portion and pay taxes on the portion that you convert each year. We're not going to get real into these details, but you can also convert old traditional 401ks or current traditional 401ks in some examples. In this example, you have $400,000 or $500,000 in a 401k, and you want to do a partial conversion. I don't want to pay tax on the full $500,000 getting it to a Roth, so I take $300,000 and roll it over to a traditional IRA, and I convert 200 of it into a Roth IRA. So I pay tax on a portion of it. This does assume a 25% tax rate on the 200,000. I'm sorry about that. That's a $50,000. So you'd pay tax on 50,000 of the Roth IRA, and it would leave you a balance of 150,000. Of course, as I stated, you want to pay from outside funds. Yes, sir.
Would there, in a regular R&D in the future, convertible to an older individual?
Good question. You cannot.
It's not working.
You cannot convert required minimum distributions. So say you decide to convert a traditional IRA this year, and you have to take a required minimum distribution in 2010.
It's not going to be available in the future then, but the same way.
Yeah, let me finish this. It might answer your question. You have to take your required minimum distribution for 2010,
Right.
pay taxes on it, do whatever you want, and then if you want to convert to a Roth IRA, you can convert the balance after that. But the RMD needs to be done prior to any conversion.
Oh,
Okay? You can't avoid an RMD with a conversion. The government wants to get paid. And furthermore, if you think about this whole concept, it's another way to mortgage the future. They want tax dollars today and not collect later. There's a few different ways to fund a Roth IRA. Does anybody have a Roth 401k? They're relatively new. You can roll directly a Roth 401k to a Roth IRA. It's not that common yet because they just came about in the last few years. So there's some information on that. How do you fund your Roth? So there's a couple of different requirements. When you convert to a Roth IRA, first, after you convert, you need to wait 5 years before withdrawing the money from the Roth IRA, or be over 59 and a half. Okay, big or. That rule applies to the earnings or the converted amount. So if I roll $100,000 and convert it to a Roth IRA, I have $100,000. If I'm over 59 and a half, I can take that $100,000 out immediately if I want. Now I would argue that it doesn't make sense to convert if you're going to take it out soon. There is so much press written about this 5-year rule. It should be almost irrelevant, because if you're going to take out the money within 5 years, you shouldn't convert. So if you're reading about the 5-year rule, don't spend too much time reading on it. Convert money that you want to keep in the Roth IRA for several years, far more than 5. If you have an existing Roth IRA and you convert and you put the money into that existing Roth IRA, this 5-year rule starts when you started the Roth IRA. So maybe there is no 5-year rule if you've already had a Roth. Again, more talk about a benefit that shouldn't be an issue. And if you do a non-qualified distribution, it gets very complicated, and you should talk to your CPA. But it's divided into basis, what you converted, and earnings. And so there would be tax consequences on what your converted Roth IRA made if you took out a non-qualified distribution. 5-year rule, prior to age 59 and a half, some other non-qualified withdrawals. Okay, or you can contribute to a Roth IRA. You can contribute to a Roth IRA and add money to that tax-free account. There is no immediate deduction or tax benefit, but that money can grow tax-free for years to come. The rules: you have to have earned income, and you have to have joint income under about $175,000. Okay, there was a question about this earlier, the after-tax money in IRAs. And if you do a partial conversion of an IRA and you have after-tax money in your IRA, you cannot avoid taxes when you convert like you may think. So let me read this. Once you roll over after-tax money or make non-deductible contributions to your SEP, Simple, or traditional IRA, you must keep separate accounting for this money, which is very difficult. There's a lot of people out there that made non-deductible contributions to their IRAs over the years. So let me give you this example. You have after-tax money that you contributed to IRAs over the years, totaling...
After-tax money.
I'm sorry?
Define after-tax money.
Non-deductible, we'll call them just non-deductible contributions.
That's excess
Okay.
contributions, right?
Or
That's an
excess, yes. Well, not excess is above the IRS limitation.
Right.
Non-deductible is simply your income is too high and you cannot
Oh.
deduct it in the year in which you contribute. So say you did that, and say you did it for 5 years and you put in $20,000, and you did this starting in the, in the 70s, 80s. You had after-tax money of $20,000. Some people think, I just want to convert that $20,000 to a Roth IRA. It's after-tax money, and I won't have to pay taxes on that. You follow that? Because it's already after-tax money. Well, what the government does is they say, well, add up all your IRAs. In this example, the total IRAs are $200,000. So maybe they deposited $20,000 over the year and it grew to $200,000. You can't just convert the 20 and avoid paying tax. They take a pro rata approach and they say, okay, 20,000 over 200,000, only 10% of your total IRAs that you have are after-tax money. So only 10% is tax-free. So if you wanted to convert 20,000 and you had 200, you would have a tax-free portion of 2,000 and pay tax on the remaining 18,000. Okay? Does everybody follow that?
No, not really.
It only applies to people with after-tax, non-deductible IRA money that are doing partial conversions. If you don't have both of those, you don't need to know any of this. But
But can't people who have that take their RMD from the after-tax money before they make the conversion? So let's say you had X, 50,000 a year in that tax rate. You can take that out as part of your RMD, pay no taxes on it in the year you take it, then convert it.
correct. Yeah, lowering this number,
Right.
making more of it tax-free. In addition, if you have this, they say the balances in all your traditional IRAs, not your old 401